Mahoney company. A very good question it is. Why countries impose, explain why, protectionist measure on imports and possible economic benefits if ACCA forms a custom union with its neighboring countries. 7 marks. Theoretical. B part. Prepare a report for the board of directors of Mahoney Company, which now calculate the impact on intra-group cash flows if multilateral netting is used. So netting question is here in front of us. Okay. Now, calculates the use of forward and future markets to hedge disposal proceeds of divestments of Oliveria company. 6 marks. So forward contract and future market. Briefly discuss using the results from 1 and 2 above. Advantage and disadvantage of to settle intragroup balances. Okay. Whether the forward or future market would be a better choice. Which one is the better choice? 5 marks. Discussion. Calculate the NPV of the in euro of the regeneration project. So NPV is also there. I think it is international investment appraisal. Once again, in ACCA, when either the currency swap or the currency option is used. Oh, wow. This is something new type of question. This is something new. Okay. Discuss the result using the part 4 above. Where, because they have merged the investment appraisal with these topics. The currency swap or currency option would be better choice to hedge the risk associated with the project in ACCA. Which one? The assumptions made estimating the regenerating project NPV. Whether that should be now you see here 3 requirements, 8 marks. So 3, 3, 2, 3 marks, 3 marks, 2. If you think 8 marks, please distribute mark. 3 marks, 3 points. 3 points and 2 points. Done. Okay, it will become easy for you. So first of all, I told you that you will open the word processor. You will give headings of all these things to make your life easy. Okay, so that you need not to open it. So 7 marks, A part. Why countries might protectionist measure. Reason for protectionist measures on imports. Second is benefits of custom union. We will see. We will get a hint from the scenario in itself. Now, 7 marks, 2 parts. Now we got the idea how marks are distributed. If it is one requirement, 7 marks, we cannot write. We get, upset. Now the next is prepare a report. So report to Board of Directors, Mahoney Company. Introduction, paragraph. Next is the intra-group settlements. We have to do the discussion. Okay. We have to discuss the results. Intra-group settlements, advantage and disadvantage. Okay. Next, advantages and disadvantages. Second is future market versus, yes, future forward or future market for as a head choice for Oliveira Company. Next, yes, NPV. Okay. The next point is NPV. Compare, discuss the results. Currency swaps or currency option. Or currency options. For project in Amasia. The next is assumptions used in NPV calculation. Next, yes, whether it should be conclusion. This is the final conclusion. Conclusion on project. So in the same, we will write the conclusion. Okay. So that will be the complete structure. And the last appendices are in spreadsheet. Appendices are in spreadsheet. BSOP calculator is also here. They've given. And it is good. Yesterday we used, that was not having these. I checked it. There was a problem. Okay, in that. So it is correct. This calculator. There was an issue in that sheet. Anyways. So we will be proceeding towards, I will be opening Excel sheet so that we can start doing the calculation one by one. And then we will come to the theoretical part as well. So intra-group settlement. Before that, Exhibit 1. M is a listed company based in the Eurozone. The company and subsidiary specializes in the large-scale infrastructure projects around the world. Mahoney Company's board is due to review an investment proposal after being invited to work on a regeneration project by the government of Amasia. Sorry. The objective of project is to significantly improve the capacity of Amasia's largest shipping port. Amasia has a relatively closed economy with significant protectionist measure on imported goods and services. Amazia's agriculture industry in the country, main source of employment and has benefit to a large extent from this protectionist. The new government has announced a series of reforms designed to boost economic growth and tackle an unsustainable budget deficit and country's high unemployment rate. As part of these reforms, the government is keen to establish a custom union neighbor. The principal objection to this proposal is that it might harm to the growth of Amazia's new car manufacturing industry. You see here that part, that part we were seeing the custom union and the protection, the first part. Our topic to be discussed on the next board meeting include how to hedge the disposal proceed from the divestment of Brazilian subsidiary, Oliveira and intra-group settlement, Mahoney company expect to receive this Canadian subsidiary Eve company. These funds are not expected to available for 6 months, but will be used to repay a bridging loan which is due for repayment on the same day. Okay, intra-group settlement. Here it is. Today's date is 1st Feb. M Company manages financial risk on behalf of the group, including the settlement of intra-group balances. The company has recently introduced a policy to use multilateral netting to settle any balances owed between the companies within the group. The base currency is euro. So settlement has to be done in euro. They have told. The following balances are owed today between Mahoney Company and three of its subsidiaries companies. The subsidiaries are Yiv Company, based in Canada. Yes. And Imran Company, based in Pakistan. Really? And Oliveira Company, based in Brazil. BRL. Okay. So owed by. So this is amount in millions. Owed by and owed to. The balances are converted into euro using the following mid spot rate. They have given themselves mid spot rate per euro. They have given. Group policy require balances to be settled in the order that company owing the largest amount in euro settled first with the company owed the smallest amount in euro. Okay. Group policy also requires settlement payment to be paid in 6 months time. Okay. So we will be making a netting table. First of all, what we need to do, we have to copy and paste all that. So multilateral netting it is. So owed by and owed to amount in million. And here amount in euro million. You have to convert into euros. So Mahoney Company, Mahoney Company to Imran Company. Amount is 5913 PKR million. Okay. Then again, Mahoney Company has to pay to Oliveira Company BRL 160 BRL. Then the next is again Mahoney Company and Y Company, Canadian dollar 86 million. Then Y company. Okay, it has to pay to Imran company 3713 PKR. Then again, this company has to pay to Mahoney second is Oliveira. That is BRL 456. And again, the same company has to pay to Mahoney company. Third, 138 million euro. The last is Imran company. It has to pay Y company $39 million. Imran company has to pay Oliveira 504 BRL. Now, we have to note down spot mid rate as well. It will make our life very easy, I'm telling you. CAD to euro, that is 1.31. PKR per euro, 218.1692. BRL to euro, 5.2131. So now we need to convert. We need to convert this all currency into euro. So 5913 divided by this. Okay. 160 divided by BRL. 86 divided by this. 3713 divided by 456 divided by this. So this is already 138 million euro already. 39 divided by this. 504 divided by. So we have converted all these transactions using, yes, mid spot rates into euro. If there is any confusion, you can ask before I proceed. Tell me. Next. So now netting table. Owed by and owed to. Yes. Three companies are there. Three companies are there. Owed by. We will write all three names here. One, two, 3. Owed to 1, 2, and 3. Simple as that. Okay, you are right. Fourth is this. 4 companies are there. You're right. Thank you. 4 companies. So now I love it when you identify my mistake. It shows you are involved in the class, and I'm loving it then. Okay. So M has to pay. Imran has to receive. M has to pay. Imran has to receive. M has to pay. Olivera has to receive. M has to pay. Y has to receive. Okay. Now come to the Y. Y has to pay. Y has to pay. And Imran has to receive. Y has to pay and Olivera has to receive. And Y has to pay and Mahoney has to receive. Imran has to pay and Y has to receive. Sorry. Imran has to pay and Olivera has to receive. That's it. Now, total receipts by Mahoney. And from here to here. Yes. Total payments. Yes. Now, the next point is payments minus receipt or receipt minus payments. Okay, receipts. We will mention Mahoney receipts. This. Imran receipts. Olivera receipts. The largest amount received by them. And Y receipts. So net receipts, I'm sorry, or payments. So receipts minus payments. Always do receipt minus payment because payment is negative. Receipt minus payment. Now, they said that How hedging, how the balance to be happen? So netting is done in the first requirement, which was here. Yes. Calculate. We have calculated. Briefly discuss the results from. Results as to be discussed in the word in the report. So I will open a Word document for it so that I can share it with you later on. Yes. So we have typed it here. Let us shift it here. So results as well. Intra-group settlements. So let us talk about the results. They said that settlement will take place. They told us. The company owing the largest, who has to pay the largest amount. Okay. So who has to pay the largest amount as per the calculations? Y company. They have to pay the largest amount. It will pay to the Mahoney this amount. The company owing the largest will pay to the smallest. Okay. So, students, how it will be discussed? It will be discussed like this. Settlement. First of all, intra-group settlement. Advantage of multilateral netting. Okay. So it will become two parts actually. Okay. So intergroup settlement. So as per the guidance given, what is the name of the company? Very difficult. We will pay 14.6 million to Mahoney company. And remaining, it will pay to, how much is remaining? 14.6 and 14.7. We can 140.7, 147.1, sorry. So it is basically this plus this. When it is paid, 132.5. 132.5. And remaining 132.5 million, it will pay to this company, Olivera company. Olivera company. While Imran company will pay 82.3 million euros to Olivera. This is, yes, mention euro with every amount because this is currency euro. Settlement is done. So what are the advantages and disadvantages? We know the marks allocation. Results above. Okay. 1 mark received for this discussion. So around 2 marks. Because 2 parts are there. 5 marks has to be distributed. So 2.5 each. So around for 2 marks, we need to discuss advantage and disadvantage of multilateral netting as well. Yes. We have to discuss that. So, how to discuss? Multilateral netting reduces the number of transactions in different currencies. Reduces the number. Hence, and settlement takes place in one currency. Here, in case of Mahoney company, it is happening in euro. So it reduces exchange rate risk for Mahoney by reducing the number of transactions and reducing the currency exposure for all group companies. It saves time as well as transaction costs. Yes. Now, students, what is the drawbacks? You know what the blunder students do? Instead of writing this, linking it to the scenario, they write generic benefits. Just like they wrote this, and in generic they wrote it saves cost and time and done. You won't get marks if you don't link it over here to the scenario. Now, the next is disadvantage. Students, now this is specific disadvantage. Number one, the drawback of multilateral netting is that some countries do not allow this arrangement. You don't allow this arrangement. Yes. They put restrictions. And the second thing is over here, which is in the scenario, requires settlements in 6 months' time. This have been prepared. Netting table has been prepared at 2 days mid spot rate. So all the countries in which Mahoney company and other companies involved in this arrangement should see whether this is allowed as per local jurisdiction. It is enough if you write it. But there is one point you can add. The settlement payment should be in 6 months' time. So drawback over here is that since the group policy, moreover, here settlement has to be made in 6 months' time as per policy of group. So this settlement may need to be calculated at forward rates. It is more than required, what we have written. Okay, next. The next part is hedging. The next part is forward or future hedge. Yes. Read it carefully, please. Yes, students, now. So the point is the currency future. Today is 1st Feb. Mahoney Company has found a buyer for its Brazilian subsidiary, Oliveira. The buyer is still negotiating the purchase price, but the current expectation is that the sale will generate net disposal proceeds of Brazilian rupees 650 billion, which will be paid on 31st July 21st July. The treasury manager is concerned about the exposure to exchange risk and has identified the forward and future contract as possible method of hedging the receipts. Now, so proceeds, what is the transaction date? Transaction date is 31st July. And what is today? It is the 1st Feb. And the next point is amount of transaction which has to be received, that is 650 million Brazilian, whatever it is, BRL. So forward contract 6 months is given, okay, in 6 months time they have given rate, futures are given, and future contract can be assumed to mature at the month end. Basis can be assumed to diminish to zero at contract maturity at a constant rate based on monthly time intervals. The number of contracts to be used should be round to the nearest whole numbers in the calculation. If amount cannot be hedged with the number of future contracts, the amount unhedged or overhedged should be hedged using the forward market contract. So let us solve it. Very interesting it is. So the second part, which is related to the hedging, appendix 2. So hedging the disposal proceeds. Yes. So currency exposure. First of all, this is 650 million BRL. It is 650 million BRL in receipt in 6 months time. Yes. 650 million BRL. Now, using the forward contract, forward contract. First of all, what is the receipts? This is the rate given. BRL per euro. They have to receive less. Here we are dividing. Divide with bigger amount. 5.3117. 5.3117. This is euro. Got this way? If there is any question, you can ask, please. Now, the next is currency futures. So currency futures, we have to solve. Amount to be hedged is the same. We have to decide now. We have to do it using the lock-in rate. Lock-in rate. So first of all, tell me which futures? March, June, September. Transaction date is July, 1st July. So September futures, they need to buy future or sell future. Contract size is given 500,000 euro. So they need to receive BRL, they need to sell BRL and buy euro. So they are going to buy contract size currency. So buy September euro futures, and the rate is 5.3427 BRL per euro. Now we need to calculate number of contracts. So number of contracts we need to calculate. That is equal to this. We cannot divide it with the contract size, euro and BRL. Camera is getting disturbed. Just a minute, please. Now, the point is, we have to divide currency to be hedged with the contract size. We cannot divide. We cannot divide it. Then what to do? Then it means we need to convert the currency to be hedged using future rate, then divide with the contract size. Currency to be hedged. Here you go. Here you go. So number of contracts. How many there are? They are 243 contracts. Yes. So 243 contracts. Students, we have done under hedging. Remember, amount under hedged, amount hedged, first of all, through futures. Focus, everyone. How much? 243 contracts with each contract this size and hedged at this rate. Okay, 243. We have to use 243. Just a minute, please. C646. 243. Yes. Now, this is the hedged amount. This is the hedged amount. So, under hedged amount, BRL. Under hedged amount. We need to calculate under hedged amount at the rate. Sorry, this is the total amount to be hedged less this. This is under hedged amount. BRL. Now, we need to calculate lock-in rate. Lock-in rate. To lock-in rate, we need to calculate. For that, we need basis. Spot is 5.2171. This is spot minus future. Unexpired basis. Unexpired basis. Today is 1st Feb. Transaction date is 31st July. And settlement date is 30th September. What is total time? 8 months. What is the remaining time? I am doing the same. I have not done that. Lock-in rate working. I am doing the same. Just focus, please. So this remaining time period is 31st July to 30th September. 2 months. So unexpired basis, 2 by 8 into this. Unexpired basis, okay? Now lock-in rate will be calculated. We know that lock-in rate is equal to spot future plus basis. We know this formula. A few minutes ago, I explained. A few minutes ago, I explained it. Now, so lock-in rate. Lock-in rate. That will be future plus this. This is lock-in rate. This is the lock-in rate. Now, if lock-in rate, there is any confusion, you can ask, please. If there is any confusion, you can ask, please. Yes. Is there any problem? Please tell me. Now, the point over here is we said 243 contracts. So outcome, what will be the outcome? The outcome over here is receipts through futures. 243 contracts into 500,000 euro. We want answer in euro. So we need not to apply lock-in rate here now. It is automatically converted. It is automatically converted. Yes, it is automatically converted. You in the euros. 500,000 into 243 contracts. And under hedged amount through forward contract. This under hedged amount will be converted at 5.3117 at this rate, forward rate. So net receipt, this is the net receipt. This is the net receipt. Student, there are 2-3 methods to do this question. If you go for over hedging, answer may be different. Okay, I went for under hedging case, so my answer is different. So that should be clear in your mind. Okay, now, so here is the answer: receipts through euros, futures. Now, this was the receipt through forward contracts, 371, and a bit less through futures. A good question. Why under hedge has been added? They have to receive this amount, okay? Total amount has to be received. They have to receive this amount, this one. Got it? And when they are receiving it, they hedge this only first through futures. So through future, there is, this amount hedged. This was not hedged, this receipt. So for this hedging through future, they are getting this euro. So which was under hedge, they are receiving it. So they have to receive it through forward contract. Is that okay? Tell me. All right. So remember in AFM, 2-3 persons are doing questions in different way, taking different assumption, different method. Answer may be different. You will get full marks if you have done applied appropriate method. So answer doesn't matter here. Okay. Now, So students, so futures is done. And the next part on the futures is here. Which one should be a hedging choice? Theoretical discussion. I suggest to you, when you are doing the calculation, immediately after that, immediately solve the theoretical part. Because the whole calculation is fresh in your mind. And you can write better over there. Okay? Now, so which one should be the hedging choice? So students, let us start discussing it. Hedging of, yes, hedging choice. As per the results in Appendix 2, for the receipts are better through forward contract as compared to future hedge. Yes. Yes. Future hedging for Mahoney company. They're better hedge choice. Students, they are negotiating the price, the purchase of the entity. Yes. Forward contract is a good option in the terms that in financial terms. If the sale of the business is probable and certain, that is, the amount to be received is confirmed. But how many marks it bears? 2.5 marks, I think it had, if I remember. Yes. Okay. 3 valid point we need to write about it. 3 valid point. If the receipt, yes. So, as compared to. But currently, negotiations are in progress. And if sale falls through, it doesn't go ahead. Forward contract is not a good option. As future contracts can be closed by taking inverse position in market to the original position. But yes, future has a downside too. In case if transaction has to take place, that basis risk is involved and actual results may differ. So if the board of company, now 2 marks discussion have been done. Third mark. Third mark discussion. If the board of the company wants to avoid risk attached with transaction amount, transaction amount, it should go for forward contract. If sale is going to be a success, done. Final verdict. 3 marks are done. Okay. The next part is here. NPV of the euro in euro of the regeneration project in Amasia when either the currency swap or currency option is used to hedge it. Okay, we will be doing it. Come to the question. Amasia's currency is the Amasian dollar, which is currently trading at $12 per euro. The investment proposal represents the first phase of a long-term regeneration project. Assume Mahoney will complete the work for the first phase immediately at an investment cost of $1,800. Then operate the port for first 3 years in return for an annual operating fee. The fee is based on the expected volume of traffic through the port. At the end of third year, ownership of project will be transferred to the Amazon government in return for $2,900 million. Okay, right? The finance therefore expect the project to generate the following inflation-adjusted cash flows. Net operating cash flows are here. Transfer projects. Okay. The projects, the board intend to finance the project with a loan, but the treasury manager is concerned about the foreignness of the project. Mahoney's bank has suggested arranging a currency swap with another company. The swap will be the initial cost with swap of principal immediately. And in swap back in 3 years' time, both swap will be at today's spot of $12 per year. Per euro. Both swap will be at the same. Okay. Now, so students, the expected inflation rates are here. The relevant discount rate for the project is 16% nominal. Chief executive questioned whether the currency swap in year 3 would be beneficial based on expected future direction of exchange rate. As an alternative to swap, he suggested a 3-year currency option for the purpose of hedging in final year 3 cash flows based on option premium of 11 million euro, which is payable immediately. The exercise price of option is $14.1 per euro. Okay. The point is, students, we need to calculate NPV under both options. We need to calculate NPV under both options with the swap and with the currency option hedging. Now, so let us proceed and solve it. So first of all, the cash, we have to calculate exchange rate. Okay. Exchange rate. That is to be calculated in any case. Okay. So regeneration, appendix 3. Regeneration project. This is one of its kind question in exam. Never tested such question before. I'm telling you. So exchange rate we need to calculate. First of all. Year 0, 1, 2, and 3. 3-year life of the project. Yes. Current rate is $12 per euro. Dollar per euro. And then inflation is here. 23% inflation is of dollar and 8% is of euro. So purchasing power parity theory. 1 plus 23% divided by 1 plus 8%. Now, the second year, this into 1 plus inflation of 18%, 1 plus 4%. Here you go. And the third year, this into 1 plus 18% again, 1 plus 2%. This is the exchange rate calculation. Students, we will be starting with the cash flows of the project. What are the cash flows of the project? Year 0, 1, 2, 3, and 4. Okay, 3. First of all, initial investment is $1,800. $1,800 million. Then is net operating fee they will get. 90. 92, and 94. And the final year, yes, proceeds for sale, transfer, 2900. These are the net cash flows of the project. In the dollar. Okay. Now, the point is, they say when they do swap, and transfer, now conversion has to take place. So conversion into euro using swap, how it has to take place? Now focus, everyone. We have calculated exchange rate. These two cash flows will be converted on the prevailing exchange rate. Okay, these will be converted, so cash flows for year 1 and 2, they will be converted at this exchange rate. Convert it into euro. Now the point is, the swap has to be taken place at $12. They say swap. I will mention swap separately. 1800. It has to be taken place at 12, today's rate. And the same will return back at the same rate. Means out of all this amount, 1800 return back at 12. Is it clear? So 150, I can mention here that initial amount 1800 will swap now, and at the end of project, this is currency swap, at same exchange rate, Next, so remaining year 4 amount, 3 amount on spot rate, that has to be converted on that date rate. You see here, what is that amount? Total amount minus 1800 through swap. It will be converted at exchange rate on this date. If there is any confusion so far, you can ask me before I proceed. Tell me. If there is any confusion, you can ask me. Now, what will be the net project cash flows? Net cash flows of project. in euros. Million euros. Million euros. Now, we can calculate simple NPV now. Discount rate given is 16%. This into 1.16 raised to power minus. Here are the present values. And we can calculate NPV. Minus 1. Any point you want me to elaborate? Tell me. Of course, exchange rate is very easy. That is purchasing power parity theory. 1 plus inflation rate of first currency divided by 1 plus inflation rate of second currency. Now, next point. Students, now is the case of currency options. Yes. So currency options, what they are saying? Cash flows of the project. Year 0, 1, 2, and 3. Here, you see here, currency option, only 2 changes are there. That is initial premium and the final year. Nothing else. So initial investment will be the same. 150 at today's spot rate. And year 2 and year 3, the net cash flows will be the same because they are being converted at exchange rate. Okay. Yes. Year 4, year 3 cash flows. Sorry. First of all, option premium. 11 million. It has to be paid at start. They said that. 11 million euro. And final year cash flows will be converted using 14.1 rates. Yes, year 4 cash flows. Year 3, sorry. it will be converted at 14 rate. This divided by 14. Exercise price of that. So these are the now net cash flows through options. 14, yes. 14.1, sorry. Net cash flows through options. By the way, it is not that technical. But if you have not gone through this topic, which is very easy, if you take it to your nerves during exam, you will get upset. But I don't know what they have tested. I have not studied it. Yes, this type of question, this is first time in the history of AFM. I am teaching AFM since last, now it is 15th year now. And before I was student and the before that, long ago, in the last 20 years at least, I have not seen this question, such question. Now, so net cash flows. So present value at the rate of 16%. This into 1.16 raised to power minus this. So NPV minus 15 through currency options calculation. So NPV is minus 15. So the next requirement is, which is the better option, swaps or option? Which one? Okay. And swap is better. It is having less negative results. And you see here, we can give one thing over here. If swap is not done, this is the rate, exchange rate, 17.94, and the amount will be this divided by this. 166. Yeah, so net cash flows are 217 here. And here it is 167. Huge negative results. So let us discuss it in the answer. Yes. So the next part is swaps or currency option. So the point is dollar is depreciating against euro with the rapid, it is sliding. We have calculated above. You see? So dollar is Amazon. Dollar is getting devalued against euros rapidly at a rapid speed. With swaps, the NPV is negative 1 million euro approximately. Yes. While while with the options, it is negative 15 million euro. Yes. This negative 15 million euro. You know, when I'm writing, immediately comes to my mind, compare the NPVs. Which one is to? Okay, 7 marks it has. So many marks. We have done calculations. Okay, calculation is done. And now, okay, here is calculation. It is 7 marks for calculation. 3 marks for this discussion. Sorry, 3 marks for this discussion. Negative million, 15 million euro. And it is much worse condition if hedging is not done. Then conversion of last year cash flows will take place at 17.94 million, and NPV will be way negative. Worse. Now, so keeping in view, swap is better option. Better option. But for hedging, but it has risk of default of counterparty. The party may default. Option can be a better choice only if there is chance of favorable movement in exchange rate in the market. Then it can be lapsed to benefit from the movement, which looks remote, which likely to have remote chance as inflation rates predict. Done. For 3 marks are done now. So 3 marks are done. Now, the next part is assumptions made. Any assumptions you remember? Students, 2-3 points you can write everywhere. First of all, variables used, costs, operating fee, transfer proceeds. They are predictable. They're credible. Okay, inflation rates are calculated properly. So, 3 assumptions you have to discuss, not state only. Discuss. So it is assumed that operating fee, cost of capital, inflations rates are accurate estimations. A minor change in these estimates make the project outcome much worse, as project has already negative 1 million NPV. Already. A minor adverse change. Yes. Second point. It is assumed that operating fee, you see, operating fee a bit more specific discussion, is almost constant. Will not increase. There can be room for negotiations, as it is a valuable project for the government. Yes. Valuable project. So the fee is based on the expected volume of traffic through the port. As volume of traffic increases, yes, volume of traffic increases, expected volume. Now, the thirdly, it is assumed swap or options are the only hedging techniques available for hedging the receipt at end of project. Yes. Since it is the project of government of Amasia, yes, this exchange of amounts should be negotiated with the government, and the company should try to get better exchange rate for amounts. Now 3 points are done. It was a bit tricky, I can say, because there were not too many points about it. Now, so students, the next assumptions used in NPV calculation we have done already. What else? Conclusion. Conclusion of all the report. So there is initially intragroup transfer, and then hedging choices for the receipts, and then is NPV. Great. Three different questions were there. So we have to conclude. So the intra-group, yes, group transfers and sale of subsidiary will create cash inflows. Cash inflows for the Mahoney group. Okay. In 6 months' time, in 6 months' time, it is happening based on NPV calculation. The project of power generation. Yes, it was the port generation, sorry. Port generation is not viable as NPV is negative. But it can be used to exploit a follow-on project. So swap is better option for its hedging of receipts. The company should conduct a review of the project, explore further options of hedging, the amounts, and conduct a sensitivity analysis of cash flows before proceeding with this project. Done. Conclusion is done. Introduction, I have not written. So introduction is quite simple. Okay. So we have to write introduction paragraph. So Mahoney company is facing different foreign currency transaction risk, and in this report netting, forward, and futures have been discussed to hedge those risks. And then NPV of the port generation project has been calculated and assumptions related to it have been discussed.